Hello, welcome back. I did made a video earlier following a suggestion from one of our subscribers to talk about the balance sheet of Alibaba. And I thought the topic was very interesting, and so I wanted to make the same video for Meta platforms, Facebook, because they are kind of on the same page and the same things, same concepts seem to be applying in this one. So we're going to be taking a look at Alibaba's balance sheet in this video and examine what's going on with the company through the years, through the last 5 years, and how it has progressed, and how that reflects to the stock price or not. So what we want to be examining here, of course, we have already taken a look at the financial metrics here. All of these are stellar. It's a sea of green, as you'll see here. Everything is green, and look at this return on capital employed or return on invested capital is pretty much what we mostly take a look at. Amazing, 32%, net income margins of 33%, 33.3%. Pretty much amazing, exactly what you would want from a company. And regardless of this, it's going down, and this is why it really is important to take a look at the financials of the company and do not get distracted by the market price, because the market price is relevant. It's just a vehicle that helps traders, trade a symbol pretty much that has to do with the sentiment of the company when we're talking about the short term. But over in the long term, things change, and the value that the company has always surfaces. So this is what we're examining here, because we want to be buying when there's like blood in the streets, and when the stock price is cheap. This is when we want to be accumulating, of course. And this way we're examining the company here, and their balance sheet is what we're going to be taking a look at next. So let's see what they are doing in terms of their balance sheet. Back in 2017, the company had 48 billion in total current assets, and today, in fiscal year 2021, they had 67, almost 66.6. This is like a 30 to 40% increase, something of that sort. But what does that mean? The total current assets are those assets that can be liquidated very quickly. These are like equivalents, like cash equivalents or cash, short-term investments like short-term bonds and things of that sort, inventory. The non-current assets are the ones that cannot be easily liquidated, like for instance, equipment and property, for example, a factory, for instance. So these two added together, they give us the total assets of the company. This is the current assets plus the total non-current assets are the total assets of the company. And of course, with assets, you get more liabilities as well, because if you have a pool, you need to maintain it. Same idea with with companies. So the total assets of the company at 166 billion in 2021, and the total liabilities at 41 billion, giving us total equity of 125 here, while it used to be 74.3 back in 2017, as you'll see here. So the total equity of the company has increased. This is again about what, like maybe 30 to 40%, something of that sort. I'm sorry, I don't have a calculator handy right now, but you can get the idea here. It has increased substantially from 2017. Now, if we go back and take a look at the stock analysis chart here, we can see what the company was doing back then, and this is a very nice thing about the tool, because you can see the price of the stock back then if you go back 5 years, and also you can see what they were doing in the important financial metrics, which I think is amazing, because back then you can see that in 2017 the company's stock price was 180, but if we take a look at the P ratio, for example, you would see that again at the same period the P ratio was about 34, so the company was overvalued back then in terms of their price to earnings ratio. But what about their price to free cash flow ratio? Again, it was 31 back in 2017. So the company was 180, it was overpriced, but the price to free cash flow ratio was 31. Now, if we take it to today, the price of the stock is 190, so it's basically the same level. But look at the P ratio and the price to free cash flow ratio now. They have dropped significantly. Look at this, significant drop. Plus the outstanding shares also used to be higher. So now we have a larger piece of that pie than we had in 2017. So you could think about this as a 20% increase in the intrinsic value of the stock that you are holding. So you're getting even more value over here through the years in 2021. And again, we're having 5-year revenue growth that keeps increasing tremendously as well. So we're talking about a different company pretty much, making tons more sales, tons more in terms of sales than what they were doing earlier. And same thing with the net income, the free cash flow that we examined. And of course, the equity was 68%. I have the number in handy here. Yeah, the 5-year total equity growth is 68%. From 74 billion to 124 is the actual 12 trailing month period, pretty much. That's the TTM that we are examining here. No, actually, that's 2021. My bad. 2021 is 124.87. If we want, we can even examine what is happening in the last few quarters. Because if we take a look at the balance sheet here, we can examine the actual quarters, and we can take a look at the quarterly. And of course, in some quarters, we can have a little bit of a reduction in total equity. This is very, very normal. Not every quarter is going to be positive. And as you see here, the last two quarters of the company, Q3 2021 and Q4, have been a little bit worse in terms of total equity of the company. But again, overall, things are going great for the company. You can see that the total equity is increasing, and even if we have a slump some years, this is very, very normal for companies that are huge, they are massive, and they can have some quarters that are mediocre or even bad. Very, very normal. I mean, a company that, especially a big company, can never have amazing quarters every year. This just won't happen. The bigger a company gets, the harder it is for them to grow. And so at some point, they will basically resort to having even zero growth or negative growth. And then alternating. Sometimes they have 1%, sometimes they have minus 1%. This is how it goes when companies get large enough. Yet the balance sheet keeps increasing because more cash flow comes in and more net income comes in. And that's what we're getting out of these companies, which is also amazing. So this is what I wanted to talk about in this video. Short one, but to the point, I feel. We wanted to examine how Meta is doing in terms of their balance sheet, in case you are interested in the assets that the company has and how that translates to stockholders' equity, pretty much. So hope you enjoyed the video, and if you did like it, please leave a like and remember to subscribe. Next week I'm opening up this too, and you may want to be around for when that happens. I will let you know how to access. And if you did enjoy watching this one, take a look at the original that I made. And in that one, I'm discussing Alibaba's balance sheet and how that translates through the years in terms of their operations. And that one is actually even better than Facebook. I didn't even expect that. Thank you for watching this video, and I'll see you very, very soon. Have an awesome day. Bye-bye.